Okay. So welcome everyone again. Thank you for joining. This is our second webinar in the Sustainable Retirement Initiative at IEN. We have a great turnout today, and it seems to be a hot topic as ESG in general has become such a hot topic nationwide. Next slide, please. So just a bit first on IEN, the Intentional Endowments Network. We are a peer-to-peer learning network for higher ed, philanthropic, and nonprofit endowments, and aligning investment portfolios with mission, values, and sustainability goals. We have 150 members of IEN, and we try to help our organizations look at the opportunities for aligning their investments portfolios with their mission and values. And that's particularly one of the reasons why we've taken on this topic of sustainable retirements. Next slide, please. The annual summit for IEN is held generally in February or March. This year it will be virtual in 2021, and it's called the Climate Action Pursuit. And the idea of the Climate Action Pursuit is that we will space out the programming over a period of 4 dates, and they will be in February, June, October, and December. The Sustainability Retirement Initiative will have workshops at each of these 4 events. Please go to the website to find out more information on the Climate Action Pursuit. Next slide, please. So just some logistics for today. This webinar is being recorded, and it will be also distributed within the next 24 hours for all those who have signed on. And we will also potentially supplement the recording with additional material from the speakers that will potentially add some color to some of their remarks that they will have talked about today. Please use the chat function and or the Q&A to add questions or comments at any time. Next slide, please. So as I mentioned, one of the reasons for starting this initiative on the sustainable retirements is that we noticed that there was a gap in helping organizations think about the retirement plans that they were offering to their employees. It's a potentially sizable market. There's 4,500 colleges and universities in the U.S. With about $900 billion in retirement assets, generally in 403(b) plans. Huge potential, but not a lot of these plans offer any type of ESG integration into the plans. We think this is a gap that employees are noticing and also clamoring for opportunities to invest, you could say, more aligned with the mission of the overall institution and or their own values. So our initiative supports institutions in ensuring retirement options we're in the process of developing a toolkit called a Plan Sponsor's Guide to Sustainable Retirements that will be hopefully useful to overcome some of the barriers that have arisen, at least in conversations that we've had with plan sponsors, of concerns around fiduciary duty being a major one, but also on performance, on risk, on whether employees are interested in these type of investment vehicles. Our initiative also provides networking opportunities, peer-to-peer learning opportunities, conversations with our experts, which we have been facilitating through a group of focus conversations, where we have now held 3 of these with about 12 institutions directly with the experts that are participating in our initiative to try to overcome some of the issues that you may be facing or some of the concerns you may be having. I want to just say a thank you to our sponsors, which are Natixis, Schroders, and Federated Hermes, as well as Gitterman Asset Management. And also thanks to the PRI, to Momentum Advisors, and to Mercer, who are organizations that are serving on our expert panel and help provide valuable information to this initiative. Next slide, please. So I will turn the conversation over now to our expert, Keith Johnson, who is what I would like to consider the dean of fiduciary duty, particularly in ERISA plans. And Keith writes extensively on the subject and is very well known in the space. And it's so kind of Keith to agree to moderate our excellent panel. Keith.
Well, welcome everyone to our exploration of integrating sustainable investment options into retirement plans and the fiduciary duty considerations associated with that. I'll be the moderator for our discussion today, and I'm also the chair of the Intentional Endowments Policy and Fiduciary Duty Working Group. So that's one of the things that brings me to the webinar. We are very lucky to have some experienced presenters on the topics. Christine Pishko from UNPRI, who's the U.S. Relationships Manager there, and previously was a Managing Director at Nuveen. Susan Gary, who's a law school professor at the University of Oregon and has been publishing on fiduciary duty and ESG investing, and also helped to write one of the primary uniform state laws that's in place in almost every state on fiduciary duty management for institutional funds. Max Meservy, who's the senior investment consultant for Mercer, advises pension funds on ESG integration and a number of other investment related things, and also previously worked in the insurance related group at Ceres. And Carrie Moore, who's senior VP and senior corporate counsel at Federated Hermes, who in a previous lifetime also was an investment manager, or excuse me, an investment management lawyer at Reed Smith, and also worked as a compliance advisor. So we've got some good, high quality, knowledgeable people. And you want to move us on to the next slide. I'll kick us off basically with just an overview of what the Federal Department of Labor has been up to. And after that, Christine will give us a little bit of a bigger picture view where the US fits in globally on fiduciary duty and ESG trends. Susan will talk more about fiduciary duties in the US, including mentioning some fiduciary duties that you never, or at least hardly ever hear from the Department of Labor and the SEC. And Max and Carrie will talk more about the role of advisors and the federal regulatory and compliance landscape. And then hopefully at the end, we'll be able to answer some of your questions. So moving on to the next slide, the big elephant kind of in the conversation at this point is the Department of Labor rule on ESG investing and fiduciary duty for ERISA funds. The rule was proposed in June, and the proposal it was pretty strong in terms of limiting the ability to use ESG. It sort of portrayed ESG as a politically motivated kind of approach that used personal values, that was an underperformer and loser. And the Department of Labor went through extensive pains to cite research which supported that view, but ignored more current research and the increasing flow of money into sustainable and ESG funds, the uptake of ESG integrated investment in the mainstream investment management industry. And as a result, there was overwhelming industry pushback to the proposed rule. And the commenters basically were 95% opposed. There was not one investment organization or a pension fund that submitted a comment in favor of the proposal. The things that were focused on in the comment letters included the research that was not referenced, which was more current, that showed that there was no financial penalty to ESG integrated investing, and that in many instances it actually outperforms the more traditional approaches. The comment letters also highlighted that integrated ESG investing, sustainable investing has become widely accepted amongst mainstream investors. There is more money flowing into it, especially over the last couple of years, and that the proposal would have essentially blinded fund managers and fiduciaries to some of the material risks and opportunities that are represented by ESG factors, which would work to the harm of US workers. So a couple of weeks ago, the DOL issued its final rule, which goes into effect in the middle of January. And much to the surprise of a lot of observers, the final rule actually walked back a lot of the assumptions and limitations that were contained in the original proposal. The rule actually endorses that ESG factors can be economically material. It uses the word pecuniary. That DC plans can include integrated ESG social investment options in defined contribution plans, as long as they're selected on the basis of pecuniary factors, i.e. risk and return. But in terms of qualified default investment alternative options in defined contribution ERISA plans, the department retained their strict, very limited, rigorous analysis and approach to that. They left the door open just a tiny crack, so it might be possible to do a QDIA that uses integrated ESG factors, but the strict analytical and documentation requirements basically make it fairly difficult. So what I would say is that the final rule actually doesn't, I wouldn't say that it's great from the ESG practitioner's viewpoint, because it doesn't really encourage use of ESG, but it certainly does tolerate it as long as it focuses on risk and return. If we go on to the next slide, it shows what is, I think, the heart of the new rule, which is the definition of pecuniary. And applying this definition really ends up getting pretty close to where the prior guidance was before June, before the proposal came out. I want to just highlight a couple of words in the definition here that I think are the guts of it. It talks about if you are going to consider ESG based upon pecuniary factors, which is what you have to do according to the rule. You have to have a prudent process, which of course references what other similar investors are doing, i.e. mainstream investors. You have to be looking at things that have a material effect on risk or return. And you can use appropriate time horizons, which in most instances is probably a long-term time horizon for pension funds that have liabilities with average maturities out into the 20, 30-year time horizon. And also, it also references investment objectives and policy. So what you're doing has to be documented and fit into the analytical approach, the strategy that's been developed, and probably be supported by research and documentation from your advisors. So if you would like to look in more detail at the new DOL rule, there is a link in the chat function to an analysis that Reinhardt did of the rule. And it'll also be included in the materials that are sent out to people with recording the webinar. So if you want to flip to the next slide, while the Department of Labor basically has taken us on a visit back to the 20th century view of ESG investing, and then returned us to the present day in their rulemaking process. Christine is going to tell us a little bit about what the rest of the world has been and is doing. Take it away, Christine.
Thank you so much, Keith. I appreciate that. Yeah, I'm going to focus on the U.S. market, but you're right. For those of you who are unfamiliar with PRI, a little bit about my organization. We are a global membership organization for investors, and our signatories are in three different categories: asset owners, so that would be retirement plans, like we're talking about today. Investment managers are also a big part of these plans, and service providers, another big part of these plans. And generally speaking, our goal as an organization is to provide guidance on ESG and responsible investment trends and developments. And just as Keith suggested, we could provide that global perspective. But if we move to slide 2 of this presentation, the work that I'm going to share today is actually a little bit of a departure from our usual publications. So I'm going to talk about some research that we've prepared on retirement plans that actually is not for investors necessarily, but we put together this work for policymakers and industry experts broadly. We published a series of reports examining private retirement systems around the globe. All of this is available on our public site. And the objective of this work is really for us to build this global knowledge base to identify key challenges that everyone around is experiencing in the design of private retirement systems, and how these challenges in this are effectively acting as barriers to the broader adoption of responsible investing for assets. So we started with the 3 biggest systems by asset size. We did Australia, UK, and the US. We're going to continue work with other regions, but I wanted to talk a little bit about, obviously, the topic is US defined contribution plans today. So let's move to slide 3. Part of it is that in the US, if you consider and go back to, there's been a huge shift from defined benefit to defined contribution in the US. And what this has done on a top-down basis is it's put the end investment decision-making process in the hands of individual investors. So it's shifted from an institutional investor making investment decisions to individual investors who are enrolled in these plans, ultimately making their end investment decisions and creating asset allocations for the retirement savings. But then, of course, within the context of these plans, there are so many more players. But in this way, the system doesn't really allow for the end user, the individual savers. They're not really naturally equipped with access, knowledge. They don't have a direct line of influence to demand necessarily that plan sponsors are integrating sustainability into the plans. So that's one of the barriers we've identified. If you move slide 4, from a sponsor perspective, and just like we were talking about as far as fiduciary duty is concerned, the plans and the sponsors actually overall have a pretty narrow objective. They're all very reasonable from a fiduciary perspective. They're going to prioritize things like low cost, ensuring strong plan governance, making sure that the outcomes are successful. You have direct financial benefits. But in this scope of their considerations, then there's very limited institutional leadership that's being provided to them from the investment managers, from the service providers, on how to incorporate sustainability, why to incorporate sustainability. And these entities are really not acting as strong advocates broadly. And then, of course, there is a fiduciary reluctance to specifically address ESG incorporation in a meaningful way. And that's just given the current US policy environment that we opened up with. There's that risk of being sued. So move to slide 5. This is a great picture because you can see the entire DC value chain here. You can see how the plan sponsors are really dependent on financial service providers, investment consultants, record keepers, asset managers to create, to make investment decisions and to create plan menus. So much going on here, but really just, the end goal of getting those options on the plan menu for investors to use is not necessarily going to result in meaningful, sustainable investment adoption for all of the money that's represented in the DC space for retirement savers. You really need support and buy-in from this entire community for all of these players to provide education, to deliver communication to the end investors so they understand what's available to them. So I have a couple of stats here that sort of share that perspective. When there are plan offerings in sustainable strategy, the uptake typically has not historically been significant. Vanguard actually reported that of the 1,900 plans for which it was the record keeper in July 2019, so just taking a snapshot, 9% of those plans offered a responsible domestic equity option. If you take a look and you parse that further and say that they're just going to look at larger plans, 19% actually offered that solution. So in total, 23% of the 5 million participants served by Vanguard were offered the option, and of these, only 4% ended up selecting the option. And that's consistent with a 2019 survey of advisors for 401k plans by the Financial Times. So only 15% of sponsors offered ESG or impact investing options. And then if you take a look at the underlying plan assets, only about 3.4% of those assets were held in strategies. So it's beyond just getting on the plan menu. There's so much more that needs to happen within this value chain. And then moving to slide 6, you could take a look a little bit more deeply at the average plan menu. So this is a chart from Brightscope. This is a little dated, it's 2016, but it shows the breakdown of asset class offering and by percentage of total plan assets. So, as far as sustainability is concerned, there's some quick takeaways on this plan menu. First, you'll notice that they're averaging just about 20 options per plan menu. That's been a goal for a lot of sponsors, is to really streamline those menus. It's a cost consideration, but it's also for simplicity for the end user. And just adding a couple of ESG strategies I talked about, Vanguard offering an equity solution, it really doesn't necessarily offer plan participants the opportunity to create an appropriate asset allocation, right? Unless you give them all of the tools, all of the building blocks, and that's a fiduciary requirement. So there are limitations there if you're just picking and choosing one in an asset class here and there. And another takeaway here, so we talked a little bit about the QDIA, and most new members of 401k plans at this point are actually being automatically enrolled into a default option. It's most likely to be a low-cost target date fund or balance strategy. This chart is from 2016 again. So 21% of the 401k assets were in the target date strategies, but something that's additional that isn't depicted here is that number actually rises to 49% of assets of recently hired 401k participants in their 20s. So just understanding that there's a lot of inertia for these investors, and as time marches on, that number is going to increase exponentially. And then also looking at this data and understanding what that means as far as all of the assets in the plans are concerned and where they're leaning. This is really likely why the ESG incorporation in target date funds was a pretty big focus of that DOL proposal, and why that was still an area where they threw down some guidance. But generally speaking, plan sponsors are looking to avoid litigation risk, and for the plan menu, it's going to be a continued cost management, and they're also very focused on not deviating from peers in terms of investment options. That makes things very safe. And one of the things that is a result of that is, as we looked, the market actually ends up being quite concentrated. So if we take a look on the next slide at that level of concentration, specifically for asset managers, in the US, the top 10 managers for DC plans manage nearly 50% of the assets. There are some bright spots from our perspective in the US market. So broadly, we find that US managers are really seeming to embrace ESG incorporation that can be specifically tied to investment risk and materiality. So that's good. There are specific challenges to including investment strategies with explicit sustainability goals, but broadly, the investment managers which dominate this market have largely publicly embraced ESG integration. And just for some color, the top 10 managers by assets under management in this category are all either signatories to PRI, making a public commitment to responsible investing, or have an affiliate, investment affiliate that is a PRI signatory. But that's the really bright spot. Conversely, this focus on ESG incorporation is typically not reflected in plan documents, right? So that's according to a Cerulli study, and that means that there's actually a lot more work to do. So moving to slide 8, we have a lot of conclusions here that we've asked of policymakers and regulators, and suggestions to industry bodies. Given the recent DOL rule, they might seem a little aspirational for us here in the US. But there is collectively, and we talked about this already, and Chris certainly mentioned this, there's an increasing public awareness of the risks associated with not having meaningful incorporation of criteria or factors like climate change into investment portfolios. And with a new US administration, we might find things moving rather quickly here. Historically, fiduciaries have focused on avoiding litigation risk, right? So not offering an investment option with documented incorporation of climate risk might, down the line be considered a risk in itself, and it's not so far-fetched. I'll just wind up with a little global comment. In Australia, there was a recent landmark case that was settled. One of their largest super funds was sued over their handling of climate change, and was settled. It was led by a gentleman, Mark McVeigh. He sued REST, which was his superannuation fund in the Australian federal court, because it failed to provide him with information on how it was managing the risks of climate change, and that suit was settled. So just a little flavor of what could effectively come to be here in the US down the line. I'll turn it back over to Keith.
Well, thank you. That makes it sound like there is a lot of work to be done in this area, a lot of education. In that vein, I'd like to turn it over to Susan Gary, who actually is one of the people that helped to write the Uniform Prudent Management of Institutional Funds Act, which is based on the same US common law that ERISA is. So, Susan, why don't you give us a quick run through of the fiduciary duty standards in the US that we have to look at if we're considering ESG options.
Great. So I want to talk about each of the fiduciary duties in turn, but I want to start with the reason that there is a misconception that ESG or ESG integration is a breach of fiduciary duties. And what's puzzling to me is that misconception continues. I think there is a beginning to be more of an understanding, and we're hearing about that today, of the fact that using material ESG factors in connection with other financial factors just yields better results. But there is still a misconception that ESG integration is somehow a breach of fiduciary duty, and that's what the proposed rule, the proposed DOL rule was trying to say. There was the pushback that Keith mentioned, and I encourage you to read the white paper that he wrote that is will be distributed and is in the chat. It's terrific. But I think the reason for this misconception is that early socially responsible investing used primarily negative screens, pull out all of the companies that do business in South Africa. That was one of the early ones. And negative screens are a restriction on diversification, and therefore under modern portfolio theory should not necessarily did, but should lead to a cost to the portfolio. So that's been an understanding. It's just not the case. So let's go to the next slide, and we will look at each of these fiduciary duties in turn. The duty of loyalty is the duty to act in the best interests of plan participants. And best interest in the duty of loyalty standard has always been assumed to be financial interests. A private trust can construct itself in a way to consider other interests, but with a fiduciary that's bound as a pension manager would be by a fiduciary duty broadly to the interests of the beneficiaries, it's considered to be financial interests. And we could talk another day about whether that's the right way to interpret best interests. But the DOL says it has to be financial, and that's fine for today. We can assume that that's the case. The misconception that using ESG factors would result in a financial cost led to the thought that using any kind of ESG factors in decision making would result in a breach, in a violation of the duty of loyalty. Given that the use of ESG factors does not necessarily result in a cost, there is no duty of loyalty problem. So we'll turn to the next slide and the next duty. The duty of care includes the duty to act as a prudent investor with respect to the funds being managed. And on the slide are listed the factors that a prudent investor considers, including both the needs of the participants that the money is being managed for and the general economic conditions, but looking at all of that across the portfolio. So if we go to the next slide, what has happened with the duty to be a prudent investor is an evolution in what it means, in what prudence means. And one of the really interesting things about the final rule, the final DOL rule, is that in the preamble, it talks about the fact that this is not a fixed in time standard. The duty of prudence is an evolving standard, and it should evolve to consider new forms of investing, new tools that are available. And although ESG integration has been around for a long time, I think financial managers are becoming more aware of how important it is and how useful it is. So if it is the case that an investment decision maker should consider all material information, that includes material ESG factors. And those factors can help to reduce risk. They can also help to improve return. One of the bullets calls out environmental factors as particularly important. I think I often have climate change at the top of my mind, but in a conversation with Keith, we talked about the fact that the S is these days pretty important given all of the political upheaval and turmoil that we're going through. So all of those factors are important. And I think increasingly, and Keith talked about this earlier, that ignoring material information, which includes ESG factors, could in fact be a failure to act as a prudent investor. Next slide. This is a statement from the Restatement of Trusts. This duty to be a prudent investor comes initially from trust law. MIFA, that statute that Keith mentioned, applies this same duty to institutional funds managed by any type of charitable organization, including institutions of higher education. And the Restatement of Trust itself says that the rules have to be flexible enough to adapt to changes. And this is what I just mentioned, this idea that things are fixed in time and we couldn't do this back in the 1970s, so we shouldn't do it now. That's just not the case. Next slide. So I wanted to mention one duty, and this is the one that Keith mentioned, doesn't get talked about as much as he and I think it should. The duty of impartiality applies to any fiduciary that is managing property for more than one person, which of course a pension plan would be. There is a duty of impartiality, which means that the fund has to be managed for all of the participants. And in a pension plan, there are some participants who would be taking retirement distributions currently, but there are also many participants who will be saving for retirement distributions to be taken many years from now, 20 years, 30 years from now. And because of that, the management of those plans needs to consider the needs of the participants with a much longer time horizon than the participants who are taking retirement decisions now. That long-term time horizon is important, and considering the needs of all of the beneficiaries is what the duty of impartiality is. Next slide. And ESG factors produce better long-term value, particularly with a longer time horizon. The studies that have looked at ESG integration look at longer time horizons. It's not a quarter-to-quarter kind of improvement. It's, some of the studies say after about 7 years, that's when the big benefits start to show up. And this need for longer term thinking is important, certainly for pension plans, as well as for other types of assets being managed. So one last slide. This is just to sum up. Does ESG integration breach fiduciary duties, violate fiduciary duties? No, it does not necessarily result in lower returns. Different funds have different return and risk outcomes. That's the way it is with all sorts of things. But there's no necessary cost to using ESG factors. It may, in fact, improve returns on a risk-adjusted basis. So there is no breach of the duty to act as a prudent investor. And using ESG factors, material ESG factors, also helps to change the focus of investment decisions to balance both short-term benefits with long-term benefits, which is important for the duty of impartiality. So Keith, back to you.
Thank you, Susan. Now let's turn the floor over to the people that are in the trenches. And Max, tell us what advisors and consultants are doing and going to be doing with their clients on these issues going forward.
Great, thanks Keith, and thanks everyone for joining today. My name is Max Serby and part of the Mercer Responsible Investment team based in Boston. Really brief background about us. Mercer's had a dedicated responsible investment practice since 2004. And one of our first engagements actually as a consultancy was with the United Nations to develop what became the Principles for Responsible Investment. And we've continued to be engaged ever since with elevating industry practice and certainly thinking very long and hard about fiduciary duty in that context. We work globally, and I think as Christine laid out really nicely, there's a lot of different pieces going into play in international markets. Our UK team in particular, a couple of years ago, was faced with the fact that their clients were suddenly being asked by the pensions regulator there to essentially explain whether they are taking ESG factors into account and making pension investment decisions, or explain why they're not. So they had to comply and kind of develop new language and put that into their investment policy statements, or statements of investment principles, they're called over there, and explain how they're thinking about these issues. And so that, naturally, when you have hundreds of clients over there in that market, created a huge amount of work for them. So just to say that in the US market, we're certainly at a different point. The latest kind of, I guess, regulatory matters have it's an interesting point in time right now, let's just say. And frankly, our team is actually digesting the new rule currently. We operate both as an advisor or consultant to regulating ERISA retirement plans of both defined benefit and defined contribution side. We also are an asset manager ourselves. And so we offer funds that can be selected by ERISA plans to be offered to their participants. So this new rule really kind of has broad implications for us. And so I don't have slides to share today simply because we are currently kind of digesting things and are going to put things out to the market soon. Now, stepping back, however, obviously we've seen a lot of discussion around materiality questions, this question of what's a pecuniary factor, And I think that the really interesting piece of the new rule is that the pecuniary factor is defined as a factor that a fiduciary, and specifically the fiduciary, prudently determines is expected to have a material effect on risk or return of an investment based on appropriate investment horizons. I think that the interesting piece is that from the proposed rule, there was this focus on just ESG, this kind of generalized term. It kind of created ESG as a separate sort of class of investments, let's say, separate from other assets one might consider. But now the shift has now been towards, what does a fiduciary believe? What does a plan sponsor believe to be material factors that are non-traditional in nature along that ESG spectrum that they might want to think about addressing within the scope of their plan? And for us, the way that we've advised clients on these matters is we have a 4-step process called the Responsible Investment Pathway, or RI Pathway. And the core piece, the first kind of piece of that process is beliefs. So establishing what do you believe to be material ESG factors, climate change, maybe it's diversity inclusion issues that you'd like to consider within the scope of your portfolio. And this goes across all asset owners that we work with, from endowments and foundations to, again, pensions and DC retirement plans, through to wealth managers. And so we try to help clients to really, first of all, understand what those issues might be. Obviously, we have a lot of research that we've done on climate change, put a lot of papers out to the market on that, and thinking about it from a strategic asset allocation perspective. But again, beyond climate change, there's so many different issues that are quite material in nature these days, from water scarcity or too much water in certain cases. And again, diversity inclusion is something that we're hearing about from a lot of clients these days. And within the scope of a DC plan, for example, how can we help our clients think about diversity inclusion in the kind of investments that they're being offered? What are managers doing to consider these factors in the way that they might engage with companies in terms of, voting proxies on the equity side, or actually just having conversations with company management to say, your board is not diverse enough. We believe that's actually a material risk to underperformance if you don't have a diverse enough organization helping you make decisions. So we really try to, first of all, educate our clients on some of these material factors. And then secondly, help them develop those beliefs, and then, train that into the investment policy statement, so that they're perhaps not enumerated specifically, but and this is where our thinking is going to evolve in light of this new rule, but really to say, how they consider, from a principles-based perspective, a process perspective, how they consider these factors and why they consider them to be material. So the third and fourth steps of the process are process and portfolio. So, if you go about selecting new investment managers, how do you consider these factors systematically as part of the analysis and assessment? And then the portfolio, how do you want to think about overall positioning of, again, those ESG factors within the portfolio? A fully integrated portfolio where every strategy is at least considering these factors on a systematic basis, or do you have kind of maybe what we might consider an ESG, tier to a DC plan, for example, where you have, a couple different asset classes represented that are kind of ESG oriented strategies, whether it's a global equity and maybe a domestic equity strategy, or a fixed income oriented strategy as well, so that participants can, appropriately diversify themselves within that ESG context if they so choose. So, as I said, there's a lot more to talk about in this space. Cognizant of the time, I want to offer Carrie plenty of time as well, but I'll stop there. Thanks.
Thanks, Max. Carrie, you've got a background in investment and compliance. So what can you tell us about how investors and fiduciaries should be approaching this to make sure they don't run afoul of the rule? And are there any things that you expect from the Biden administration to affect how this all plays out?
Yeah, this is an interesting time for all this to be rolling out. Yeah, I work for Federated Hermes. We're a very large asset manager who believes that sustainable investing is a critical component of long-term performance, and we have integrated ESG factors into all of our products in one form or another. And so for us, we are focused on this role as a asset manager, as a product developer, to ensure that that fiduciaries that are interested in investing in our products are able to do so in comfort with the DOL rule. So we're monitoring this all of the time. And one of the things that we're focused on, to kind of carry over from what Max just said, is that, you know, as these fiduciaries are coming up with their beliefs and what the material factors are, there is some hesitance you'll see from the fiduciary standpoint on how to do that. And the reason they're hesitant is because ESG investing, like any other form of active investing, is subjective. And ESG investing might even be more so, because you know, there's such a variety of non-financial information that goes into the definition of E, S, and G. And it's all, you know, related to corporate behaviors, policies, and operations. And while there's a rough consensus on what core ESG factors are, you know, there has to be judgment as to whether a given factor is good or bad, or how much weight should be given to that factor. And, you know, that's a process. And the good news is that due to the increased popularity of sustainable investing, there's more ESG data now available than ever before. So there's various non-governmental organizations that release sustainability statistics. There are ESG information services that sell data. There are multiple ESG indices. There's credit rating agencies are now factoring ESG into their credit ratings. So the information is coming, and that's a good thing, because you know, we've always needed to consider material factors, and at the time, you know, in the past, you know, maybe certain governance factors were readily apparent, maybe certain environmental factors were readily apparent. Well, now we're getting more and more information to help the fiduciaries to, you know, determine really what is material or not material to the investment. The problem with this abundance of information is that it's not all that transparent all the time to all types of investors. It's certainly not consistent, and it's certainly not readily comparable. And that's sort of we get it because of the subjectivity of ESG in and of itself. There's a reason for that. So how do you you know, approach that? The good news is that the regulators are starting to focus on this. You've had sort of the industry trying to solve the problem in various ways, because we see it, we understand it. So you've seen different components of the industry trying to come up with a way to streamline these types of disclosures, to come up with a consistent disclosure regime with varying success. What you're finally starting to see is the SEC is taking notice. They've been asked to take notice by the industry. The current SEC has been a little hesitant to do this. It's just not normally, they're not normally a prescriptive agency, and that's understood. I think though that as they've seen the interest in these types of investments grow, the materiality of this type of information become more apparent. They realize that maybe it might be time to step in. And recently, the SEC's Investor Advisory Committee focused on this area and made recommendations. And they concluded that mandatory standardized reporting by issuers would significantly mitigate the problems with data inconsistency. Investors and third-party data providers would benefit from this type of information, and that so far the market forces haven't been quite adequate enough to come up with a solution. So they believe that additional regulation could effectively promote some sort of standardization with these disclosures. What does that mean? So what I think you'll see, especially under the new administration, is an SEC that focuses more on, there's always been materiality requirements for public companies, of course, but I think what you'll see is they're going to focus a little bit more on some of those disclosures, a little bit more requirements on board consideration of diversity matters, on climate change, on human capital disclosures, things that they touch upon in some of the regulations today, but really aren't consistent with across the board with the regulation that's out there. So I think you will see additional focus from the SEC on that front, which will help the industry as a whole. On the second front, what we've seen and what we're focused on, especially because we have, we are a mutual fund provider, is that the SEC has proposed rulemaking related to mutual fund names. And I think this will be helpful to this group here, because if you're trying to work in your compliance under the new DOL rule, which requires ERISA fiduciaries to focus on prospectus disclosures and how those investments consider non-pecuniary ESG factors, this names rule is proposal is intended to help that. Basically the names rule requires that if a fund's name suggests a particular type of industry, geographic focus, or investment, then that fund must invest at least 80% of its assets in that type of investment industry or region. What the SEC found is that the industry is a little bit kind of all over the place right now with the names of its funds and what it's actually doing and what these funds are actually doing. So I think what you're going to see, they haven't issued, the final rule has not come out, but I think what you probably will see in the final rule is a little more focus on if you are really a fund that invests in non-pecuniary ESG type of investments, meaning there is some sort of collateral benefit other than a financial benefit that you are focused on, that's going to have to be addressed more clearly in either your fund name or your strategy. Most funds, as some of the other panelists already noted, that are out there are what we call ESG integrated funds, where they just simply integrate ESG non-financial factors into their portfolio considerations. That type of ESG integration has always happened. It's been, these types of advisors have always considered material non-financial factors. They can consider them today and they can consider them tomorrow under both the DOL rules and the SEC's proposed names rule. And I don't think it changes much. You might start to see additional disclosures in the prospectuses that clarify that the fund is an ESG integrated type of fund versus an ESG, let's call it themed fund. You might see some changes there, but I think those are helpful changes to an ERISA fiduciary who's trying to navigate the new DOL landscape. So those are the things I see kind of coming down the pike from there. Now, as far as a change of administration, I'm sure the whole panel could talk about this, but I think that the DOL rule will go, this DOL rule will go into effect prior to the change of administration. So it isn't as a simple action of them just staying, a new administration staying the rule. The rule will go into effect. So we've been kind of counseling our clients to just assume that the rule will be around in its current form for some time. There may be some changes that happen with the new administration. I'm sure they will probably be focused on this area, both in the DOL and at the SEC. But for now, the rule isn't going to be overturned simply, but I believe it will be focused on.
All right, thank you. I think I'm going to turn it back to Chris now, who's been looking through the questions that were submitted both on the chat during the webinar and prior to the webinar. So, Chris, why don't you tee us up with some questions from the
Sure, Keith, and thank you, panelists, for very informative presentations. I think building on what Carrie was just saying, we have a question on the new rules. Does a portfolio manager using ESG factors have to document how these factors affect financial risk and reward in the portfolio? And if so, how should this be done? So maybe Carrie, you want to start?
Yeah, I can start, and Max might have some, I know he's got some thought on this too, probably, but yeah, the answer is, well, there's certain parts of the rule where you have to be very specific in your documentation. If you get into a tiebreaker situation where you've got two investments that you're looking at from a pecuniary standpoint, and then you want to use non-pecuniary factors as part of that analysis. The rule is very clear that you need to be documenting how that analysis happens. But from just a general standpoint, as the panel said, the good news about this rule is that they moved the terminology ESG and ESG investing out of it and just talk about pecuniary and non-pecuniary. So the way you should, I think the way you focus on this on ESG investments is the same way you would focus on any other material factor that you are considering as part of that portfolio. How do you document that you are, making the right decision with respect to any of your decision making within the portfolio, within the lineup, or that sort of thing. It's ESG. The whole point of the change between the proposed regulation and the new final regulation is that ESG doesn't need to have special consideration, or it shouldn't have special consideration. It's just another material factor that the fiduciary can and should be looking at. And so you just roll that into your documentation normal course. Now, I think it is beneficial, given the focus on this and probably the focus from the DOL, at least in the near term, to maybe note there was in the preamble discussion about reading and understanding the prospectuses. Do you maybe add something in your process that that we read and understood the ESG disclosures in the prospectus? I think that's common sense. That might be good practice. But as far as just completely having to redo the documentation and the oversight on these types of investments separately, I don't think that's really the case. It's more of a note here, a thought there. I don't know, Max, if you have a different thought on that.
No, I think you've covered it well, Carrie. Mindful we're almost up on time, so I'm sure we want to get to other questions.
Yeah, I want to just add something to this too. I think it could be important to make sure that your advisors and consultants and managers are up to speed on a lot of the recent research and findings relating to sustainable investment in ESG, because it can be a disaster if you're using somebody who is rooted in the 20th century views and understanding of ESG investing and hasn't been updated. Chris, do you have any more questions from the?
I'm sorry, Keith. I thought I was unmuted. Apologies. We had a question on passive management, how the new DOL rule would potentially impact passive management. Can you hear me?
Yeah, I'll just say that, passive management is and always has been an acceptable form of ERISA fiduciary management. That's already been just determined by both the DOL and the courts. So I don't know that this really changes much. It's not saying that ESG, looking at ESG factors is required in a passive environment. I think that passive management continues to be an acceptable form of fiduciary management. I do think you'll see, again, with some of these, even the target date funds and things like that, integration of ESG in those types of funds. So even if they're in some sort of, of a more passive environment, the ESG component might even be in there, even if you're unaware of it.
Thank you.
Yeah, let me add, Chris, that I think that you will probably start to see, I think what's happened in Europe is there are lots of, there's a lot of thinking going into developing new types of passive indices. So, you may not be stuck in the future with just, 3 or 4 options, the S&P 500, Russell 2000, whatever. But there may be some sustainable index options that are well researched and designed on pecuniary factors.
Right.
And I would add to that, I think we have been seeing quite a lot of really interesting, innovative work from index providers, who are developing customized indices, and may look at, climate change being top one that many are taking a look at. And also just energy transition. As we transition towards a low carbon environment, of course, that creates risks to traditional energy providers. And so you want to perhaps tilt towards those who are more well-positioned for that transition. So we're seeing new indices come to market, and then they're combining with some of the passive investment providers to offer funds on the market overseas, but also we have seen some implementations here in the United States and helped clients with those as well. So I imagine, again, I think going to Carrie's point, this new rule I don't think is going to overly negatively affect the passive market in particular.
Unfortunately, we've hit the top of the hour. So I want to thank, first of all, the panelists, Keith, Christine, Susan, Max, and Carrie. Thank you very much. This was very informative. I also want to thank all the participants. Please reach out if you would like to participate in this initiative. We are open. There is no cost to participate, and we would be happy to have you to join us. So please reach out. And thank you, Hannah, for serving as a great coordinator on this. So thank you, everyone, and have a great day.